Thanks very much, Rich, and thanks to you and your team at the Yale College Council for organizing this event and taking seriously your responsibility to, put great events in front of the Yale community. This is really, really valuable and hopeful and helpful. It's fun for me because I get to come back and join three of my former colleagues in the economics department and talking about the current crisis, and a member of our law school faculty. And so I'm very much looking forward to tonight's conversation. I do have some views of my own, but I won't be making an opening statement. I'm going to wait until I'm provoked by something someone else says. So let me introduce the panelists who will each make opening remarks of 5 to 7 minutes, and then I think we'll proceed by having a little discussion up here, which I'll try to moderate and direct questions and engage the panelists with one another, and then we'll open up to questions and comments from the floor. There's really a lot to talk about. This is an unprecedented crisis well, not unprecedented in U.S. history, but in the lifespan of pretty much everyone in this room, it is certainly a one-of-a-kind event. Bill Nordhaus, the Sterling Professor of Economics, will lead off the conversation and talking about the broad macroeconomic picture, diagnosis, and maybe he'll venture a little bit of prescription as well. Bob Shiller, the Arthur Okun Professor of Economics, will talk to aspects of behavioral economics and how they reflect upon this macroeconomic crisis, and how those issues recognizing those issues are part of the solution. John Geanakoplos, the James Tobin Professor of Economics, will talk more about the financial markets and how they were in part the cause of the crisis, and how they might be used to solve the current situation. And John Macey, who's an expert on banking regulation, among other things, will talk about reform that's needed in the financial sector and offer a few more observations about the politics of the current crisis. So that's basically the format for the opening statements. I think we'll range all over the place. This crisis obviously has many components. It's got the problems in the housing sector where it started. It's got the problems in the banking sector where it spread to and practically brought down. It now has a broad crisis of confidence and a freezing up of credit throughout the economy, and major macroeconomic implications in terms of a rising unemployment rate. So there are a lot of issues and a broad range of policy instruments potentially available to address them, and I'm sure we will go all over the map in the course of this conversation. So let's start out with Bill Nordhaus.
Good evening. Where are we, and what should we do? I'm going to talk about where we are in these opening remarks, and then maybe we turn to the other half of it. These are central issues where we are for the incoming Obama administration. They are required to clean up the mess left by years of private greed and public indifference. And what I'd like to do is mention where we are and what the particular features of this business cycle, the unique features, are. There's little doubt we've entered a long and deep recession. Every recession is different. They're like hurricanes, in terms of severity, duration, breadth, and the sectors they hit. One way of measuring the size of a recession is the fraction of a year's income that is lost. The general estimates, consensus estimates, is it will lose between 20 and 25% of 1 year's output or national income over the next 4 or 5 years. This is a severe recession. It's about equal to the deepest recession of the post-war period, which was the deep recession from 1980 to 1984, although it's much smaller than the Great Depression. CBO has estimated, and other private forecasters have estimated, that the stimulus plan will cut this gap by about a quarter, maybe a little more. They may be a little optimistic in their forecasts, but roughly speaking, the stimulus has handled about a quarter of our problem. Now, what I'd like to do is talk about some of the various important different features of this cycle. I won't start, it all began, as the President said, with Housing, we talked about that many times, and you've heard about it, so I won't talk about it. It was a very unusual bubble. Bob Shiller has written about it. We've come back a fair amount toward the trend, but we still got a ways to go. The first interesting and important feature is that partly because of housing and partly because of other markets, more visible markets, households have taken a tremendous hit to their wealth. I don't have to tell most of you that, but in terms of peak to trough, the household net wealth is down about $18 trillion. Now, whatever that number means, in terms of the average household wealth is down $150,000 per household in the United States. We might add some of the government debt to that. It is the largest and rapidest fall on record in the United States in terms of how fast and how far it fell in this basically year-and-a-half period. A second unusual feature is our banks. Our banks look as if they're bankrupt. We don't know for sure, and indeed it's extremely difficult to know given the complexity of bank accounting. But from what I do know and gather, the banks, if you sum up all the net worths after we do our stress test, if you sum up all the net worths of the bank, that'll probably be in the order of about $1 trillion. The Obama administration has set aside about 1/10 of that to recapitalize the banks. That's clearly not enough. And how we're going to get the rest of it and how big it is, I just don't know. But we cannot get the banking system back to a functioning basis until we get the banks recapitalized and get the federal government out of their management. A third newish area is a central part of the modern financial system is asset-based finance, particularly residential mortgages, but also consumers and commercial real estate as well. This is severely wounded, this whole system. The problem is a different one from the banking system because we don't know how we're going to get that system going again, whether it's going to be replaced, and if so, how. But it's a very badly wounded part of our financial system. Sixth, you're counting, and unique since the 1930s, is that the traditional monetary policy is out of business. As we put it in macroeconomics, monetary policy is in a liquidity trap, and the central bank has run out of ammunition. This is because when short-run interest rates get to zero, there's no place further to reduce them. Now, it is true the central bank can do other things. It can buy long-term securities. It can try to reduce spreads, but those are much more difficult and much more controversial. And as the Fed does more of these, its balance sheet takes on more junk. It's really taking on fiscal tasks, and it's making central bankers very nervous. Final point is that fiscal fatigue is setting in. Our budget deficit for the current fiscal year is projected to be $2 trillion. This is about 14% of GDP, and it's by far the largest ratio in peacetime US history. Outside of wars, and we're talking about shooting wars like World War II, the largest one was 5%. So it's almost 3 times larger than the runner-up. Now, even people who are usually relaxed about debts and deficit are getting nervous about its size. And the problem is that if we need another dose of fiscal stimulus, as I think we surely will, and if we need another TARP to capitalize the banking system, as I think we surely will, then there's going to be increasing resistance among economists, citizens, policymakers, members of Congress. And at some point, people may say, I'd rather just take my chances and let the economy do what it does rather than run larger deficits. And given everything that's going on, we're going to need to do more. So I think you get the picture. We can come back to remedies later, but what I've tried to suggest is that we do have these very unusual features that are actually very challenging for economic policy today.
So I've been rather shocked at the change in our level of economic confidence and confidence in our system lately. I was recently at the World Economic Forum, and there was a session that Maria Bartiromo had in which world leaders from all over the world were asked to express their opinions about the current crisis. And I was kind of shocked. It seemed to be unanimous that this crisis was challenging our economic system, that we will never go back to the old framework. I didn't find anybody who stood up for some of our old concepts of efficient markets, let the markets function. I stood up and said that because nobody else was saying it. There's a number of examples. Alan Greenspan, in recent testimony, said, "The whole intellectual edifice of modern risk management has collapsed." I read an article by Kevin Rudd, who is the Prime Minister of Australia, and I'll quote him, "From time to time in human history, there occur events of truly seismic significance, events that mark a turning point between one epoch and the next, when one orthodoxy is overthrown and another takes its place." And he went on to say that our market system, as it has functioned, is really gone, or has to be replaced with something else. So it sounds a little worse than Bill Nordhaus, "This is a bad recession." I'm talking about how other people are reacting to it. A recent University of Michigan Reuters poll asked Americans well, 2/3 of Americans said that they think that the current crisis will last at least 5 years. So we are actually fearing the Great Depression. And the bill says we're not there, but Americans, I think it was another poll, 30% of Americans think that we're in a Great Depression right now. And the interesting thing is that it seems like an event like that is a self-fulfilling prophecy of sorts. You remember the inaugural address of Franklin Delano Roosevelt, who said, "The only thing to fear is fear itself." But that's exactly what we have now. Economist Roger Farmer wrote a book called The Economics of Self-Fulfilling Prophecies, and we used it as a textbook here for our graduate students once. But he didn't have a theory about what creates these self-fulfilling prophecies. If everybody thinks we're in a depression, they might all contract their spending, and they might stop hiring and stop planning to expand their businesses. But he didn't have an answer as to when that happens or why that happens. And so that's the concern. Anyway, I've written a book about this, which with my co-author, George Akerlof, at University of California at Berkeley. And the book is entitled Animal Spirits, how psychology drives the economy and why it matters for global capitalism. And the theme of our animal spirits is a term that John Maynard Keynes popularized. And it refers to the inconstant element of human nature, that people change their thinking. And this is what is so striking right now. It seems like in the last couple of months, I sense a change in people's thinking. I talked to taxi drivers, and I listened to them, and I just recently had a panicked taxi driver. I almost felt like I had to hold his hand because he was so nervous and he thought he was going to be wiped out by this crisis. So that's where we are. So anyway, I've written 2 books, and you've given me 5 minutes, which I've already exceeded, I think. But let me just say that Bill Nordhaus pointed out the difficult situation we're in. And I agree with Bill that we need to in order to deal with this problem, we need a stronger fiscal stimulus, and we need a better capitalization of banks or better policies to get credit going. But I also, and that's one thing that George Akerlof and I emphasize in our book. But I also think that, and this is, I think, equally important and not emphasized enough, that reacting to a crisis that has people so panicked, we have to think about reconstructing the system creatively. Well, that's what a lot of people are asking for, but we have to be inventive about doing that. And in my other book, Subprime Solution, I gave 3 main areas where I think inventiveness should be developed further. One is in improving the information infrastructure of the economy, and such things as improving financial advice, consumer protection, better disclosure, and better economic units of measurement. I was just inspired that one foreign country I just got a letter from someone saying that they were thinking about one of my proposals to create a better indexation system, what I call indexed units of account. And it reminded me that we really have a very flawed system. It reminded me of what Professor Irving Fisher at Yale in the first half of this century, he said that a big part of the problem of the Depression was a debt deflation problem, that people have nominal debts and deflation magnifies them. So I think we could fix that sort of thing for the future by better indexation schemes. Secondly, I think we need to improve our financial markets, make them work better, not punish them, not shut them down, not try to outlaw derivatives, but try to make the risk management better. And so this crisis was substantially due to real estate risk management failure. And so that's one example of the kind of risk management that we should try to get going better. And finally, we need, I think, improved retail products that would help consumers better. Things like home equity insurance, or what I call continuous workout mortgages that would protect homeowners from the kind of market fluctuations that have hit them. So homeowners are in default now often because the market has made a move, and it's not their fault, and they know that. So we need to have a system put in place to prevent that. So just to sum up, I think that we have not only short-run problems, but we have long-run problems. And to get confidence back, we have to start thinking about how we're moving to a new and better world. And thinking about how to do that takes some creative invention, some financial engineering. And finally, the purpose of all this is to make our economic system work for the people. We have to democratize our financial system and make sure that the risk management is actually helping everyone.
Thank you, Bob.
Let me start, by the way, by thanking the Yale College Council. They put this debate on last time, and John O. introduced us, and I didn't get a chance to say what I'm about to say now. 20 years ago, he's sitting right here in the second row, 20 years ago, his father was a brilliant PhD student here who wrote his dissertation with me, and I'm happy to see his son now back at Yale from Korea as an equally brilliant student named John. And so thank you for inviting me and putting this all on. Now, I have I think the problem is not that complicated. There's a very definite cause of it and a very definite way of attacking it by getting straight at the cause. And we've dithered and dallied for 2 years. 2 years ago, we should have known this was happening and started to deal with it then. Had we done it, the problem would have gotten that bad. There's still a chance to do something about it. The problem is that the Fed should be managing leverage and not just managing interest rates. So Shakespeare understood this 400 years ago. As I said last time, in The Merchant of Venice, the most famous negotiation ever appearing in literature, they negotiate Shylock a loan to Antonio, they negotiate the interest rate, but they also negotiate the collateral or the leverage. Now, Shakespeare obviously thought the leverage was much more important than the interest rate. Who can remember the interest rate after all? Everybody remembers the pound of flesh collateral. So collateral, when you get a house, you put $20 down, you buy 80. That means $20 of cash allows you to buy a $100 asset. You're 100 to 20, 5 times leveraged. That's what I'm talking about. So in standard traditional economics, supply and demand determines the interest rate. One equation, one rate. That's supposed to be the most important variable in the economy. Everybody talks about it all the time. The Fed's always supposed to do something about it. Actually, at this debate, my colleagues were still talking about it. I'm glad that now we see that the interest rate is not the problem this time. It's already gone down to 0. You can't make it any lower. But even 4 months ago or 1 year ago, the interest rate wasn't the heart of the problem. It was the leverage. So variation in leverage makes a tremendous difference to asset prices. Why is that? Because all buyers aren't alike. The buyers of assets, some of them are more natural buyers, more inclined to buy it for various reasons. They're more sophisticated, more risk tolerant, more optimistic, whatever. They're more natural buyers than the others. If the natural buyers can get their hands on more money by borrowing more, with their $100 house, they can borrow about 90 instead of 80, they'll spend the money buying more assets, and so the asset prices will go up. So, I'm going in the wrong direction here. Move forward, not backwards. Okay, so the leverage cycle, what is the leverage cycle? In normal or Boolean times, there's too much leverage, too high asset prices. In bad times, uncertain times, there's too little leverage, too low asset prices. Leverage dramatically increased. In 2006, on the subprime, the subprime mortgages and other so-called toxic mortgages, there were 2.5 trillion of those toxic mortgages. The average mortgage was leveraged 16 to 1. That means $150 billion bought all of the 2.5 trillion of mortgages because the other 2.35 trillion was borrowed. Two people, Bill Gates and Warren Buffett, alone could have bought every single toxic mortgage in the entire world just by putting their own cash down and borrowing the rest of it. No wonder the prices got so high. It only takes a few wildly optimistic people to push the prices that high when they're able to borrow so much money. Recently, leverage has crashed. Those same toxic mortgage securities, their price is much lower, but as a percentage of their now much lower price, you can only leverage them, you can only borrow less than half the money. They're leveraged 1.5 to 1 or 2 to 1. Sometimes you can't borrow at all. Homes, you used to be able to put 5% down in 2006. That was 20 to 1 leverage. Now you have to put down 20% if you can get a government loan, otherwise even more. So leverage has crashed. This leverage cycle has happened over and over again. This isn't the first one, and here's a history of haircuts anyway. So leverage has an important effect on the real world. I'm the James Tobin professor. This is why I love to say this. This is James Tobin's idea, Q. If the financial system collapses, all financial assets have very low prices. That means by buying them, you can get very high returns. The prices are so low, probably if you wait long enough, you'll get a high return. Why should anyone do anything new? Why should anyone give a new mortgage to someone? Why should anyone set up a new company? They can invest in an old company, half the price it was a year ago, or loan to an old mortgager at 55 cents on the dollar. Why give a new guy $102 when you can do $55 on the same quality loan of an old guy's? Okay, so this is the story of the leverage cycle. It's a story of rational agents. It's rational when times are certain to have a lot of leverage. From the individual's point of view, it's rational when people get nervous to demand little leverage, a lot of collateral. Individual rationality, but social disaster. That's why it has to be managed by the Fed. Shakespeare knew this too. The end of the Merchant of Venice is the regulatory authority sweeps in, doesn't change the interest rate, doesn't change the amount of the loan, just changes the collateral. Says it's not a pound of flesh, it's a pound of flesh, but not a drop of blood. So what should we do today? Well, every leverage cycle ends exactly the same way. All these historical leverage cycles, they end with 3 things happening. Some piece of something scary and uncertain, something bad happens that creates more uncertainty. That uncertainty is what causes the lenders to raise the margins and demand more collateral. The margins tighten, leverage plummets, people have to deleverage, sales are forced, prices fall, and many of the optimistic buyers go bankrupt. So to get out of the problem, you have to deal with the 3 symptoms. You have to deal with the bad news, which is foreclosures and housing prices. You have to re-leverage the system, and you have to put more cash into the bankrupt players that want to keep going, like the banks. So just one word on each. How do you stabilize housing? Hopefully I have time to talk about this later. You have to take the housing foreclosure decision out of the servicer's hands. They're totally screwing it up. I hope in the question period I can explain why. And what you need to do in order to get homeowners to pay again, lowering the interest by 1% or 2%. That's, I believe, what they're going to propose tomorrow. That's not going to do it. You have to write down the principle. So here's a picture of who actually is defaulting on their homes. If you look at this graph, it's for each different kind of mortgage. The top one is subprime mortgages, and you see at the bottom, that's the loan to value, the current combined loan to value. So 60% means the house is worth 100, the number below is how much the loan is. If the loan's only worth 60 and your house is worth 100, everybody pays. If the loan is, the house has fallen in value, so the loan is now 160 times the house, every month, 9% of the people are defaulting. That's every month. It's not unemployment that's causing them to default. 9% of people don't go unemployed every month. Every month, 9% more people start to default. Why? Because the house is only worth half as much as their loan. Why pay $100 on a house that's worth 50? Okay, so we'll come back to that, I hope. The second thing, the collapse in leverage, the crunch of margins being tightened. The Fed has to re-leverage the system. It can't just give money to banks and hope that the banks are going to turn around at more generous collateral. They're nervous. They have a right to be nervous. It's scary times. The banks are going to ask for too much collateral. No one will be able to borrow much money. The Fed has to go directly around the banks and directly lend to the people who are willing to borrow and spend. And then lastly, the Fed and the Treasury have to put more money into the bankrupt players. Now, what does that mean? It's going to be a lot more money than they've admitted. These banks like Citibank that has $2 trillion of assets and $2 trillion of debt, and somehow they're just barely balancing, and they're not balanced. They're obviously hundreds of billions of dollars short. All these banks are in deep trouble. Okay, so we have to face up to that. It's going to cost us hundreds and hundreds of billions, if not trillions of dollars. We're not going to rescue them that way. We're going to have to decide that they're going to default on some of their loans. We have to start thinking about which loans can they default on. Who can carry the bag aside from the government? Okay, we can talk more about this later. Thanks.
Okay.
So it's great to be back once again in this forum. Thank you, John, for inviting me again. As a securities professor, I'll invoke the privilege of the profession and just incorporate by reference my previous comments from the last meeting and then move on to make 3 quick points within my 5 minutes about where we are in the current crisis. The first is a plea to us as citizens about how we should be in our private lives as citizens kind of confronting this problem. A second is to kind of give you a window on an unexplored problem associated with this crisis, which is the kind of disjuncture between the economic, the best practices economists have for approaching this crisis and the kind of legal and regulatory structure in the financial industry that actually exists. And then the third thing, so that you won't go home disappointed, I'll explain how this problem can easily be solved, the financial problem. So, first, the major point really that I hope to convince you of is that there's something fundamentally wrong, not with what is being said about the financial crisis by our leaders, but rather with how it's being said. That is to say that the political discourse associated with the economic crisis, the bailout bill, the recent stimulus plan that was signed into law earlier this afternoon, has been fundamentally anti-democratic in that, whether you agree with it or disagree with it, I think it's been anti-democratic in that all sides are taking the sort of professional, kind of, if you will, elitist position that says, this is not, you kind of, average people don't really understand this. We're in really big trouble. Here's the way to solve it. Paulson said this, Geithner said this, the world will end. Particularly at a university like this, we ought to be able to expect our leaders and hold our leaders to a standard that they should be able to articulate to us in some kind of coherent fashion exactly why it is that it's necessary, for example, to mention one of my favorite provisions from the stimulus plan, to build this light rail train from Las Vegas to Los Angeles, and how that's going to save us from financial oblivion, and many other aspects like that. So basically the idea is I think it would be better to have to take the view that this is that we should try and resist the tyranny of the experts and try to demand from our leaders not a financial plan or a stimulus package or a bailout bill that we agree with, but at least is presented in an articulate way such that the normal sort of democratic processes can be used, because I think this kind of tyranny of experts is fundamentally anti-democratic. The second point I want to make is that this is this sort of quasi-technical point, is that there has been a certain regulatory structure in place, not just in the U.S., but in the world with respect to financial institutions, and that we have fundamentally abandoned that regulatory structure. And it's not at all, we're going to have to erect an entirely new regulatory structure moving forward. And that's going to be a very good job, and a very big job. And here's basically what I mean about that. Generally speaking, the financial institutions, the financial structure of economies in developed countries all over the world have been constructed in a kind of analytically, we can think of them as concentric circles. In the middle of the concentric circle is the commercial bank, the old-fashioned horse-whip and buggy financial institution that essentially took transaction accounts, deposits, and made commercial loans. And then building out from that, and the structure of the regulatory system was to reduce the risk associated with those financial institutions as much as possible. And then moving out from that would be institutions that would be able to accept more risk, like investment banks, hedge funds, private equity firms, insurance companies, all sorts of other firms in the economy. And the idea has been among central bankers who are involved, not all of them are, but they are in the U.S., central bankers who are involved in financial policy, the idea is that the other financial institutions in the economy should be a source of strength for commercial banks, because that's really, if you sort of think about a triage, that's really where the aspect of the economy we have to protect. It's where people's basic savings are or should be, where people's keep their money, and where we have transactions occur that have to occur for the economy to move on. We've moved to exactly the opposite of that model. We now have, particularly with the move of Goldman Sachs and Morgan Stanley to the banking model and some relaxation of some regulations we can talk about. Our model is now clearly the inverse of what it used to be. Now the notion is that our commercial banks, the Goldman Sachs Bank, now the Morgan Stanley Bank, should be a source of strength for all of the other financial institutions in the economy. And it's not at all, this is a very bold new step, and it's not at all clear that this new model of kind of financial regulation will work, and it'll be extremely interesting, in my view, to look over the next several years, see how this works out. Finally, in my last thing, I told you I would solve this crisis. So what do we need to do to solve this crisis? Well, we need some mechanism for generating wealth in this country, for increasing demand at a time when people are saving a lot, for bringing in a spirit of entrepreneurship, to have lots and lots of kind of loci of wealth creation, if you will, in a way that's consistent with U.S., what I view as the best kind of U.S. traditions. We're not going to do that by printing money, subject to the Council of the Economists colleagues on the panel. We're not going to do this. So how can we do it? Well, the answer is simple. We do it the old-fashioned American way, immigration. Immigration, that is to say, that to my way of thinking, the only coherent mechanism. We could talk about monetary policy and fiscal policy, but at the end of the day, we have 5 million empty houses in this country, growing at a very quick rate, and by liberalizing what I think was the extremely overly strict recent immigration policy, the Bush administration, and even prior to that, I think we would begin to see new attitudes coming into the country, new entrepreneurial spirit. And I jokingly before this, I called this the Rick Levin plan, because I just proposed doing for the country what President Levin is proposing to do for Yale by building the 2 new residential colleges. But I think that regardless of what your view is on the residential colleges, I think that we should look at a liberalized immigration policy as a cornerstone to addressing this financial crisis. Thank you.
Well, I thought I'd try to lead a little discussion now among the panelists before opening it up. But first, a couple of observations. Those of you who are Yale students, which is most of you, you're going to have opportunities as you move on into your careers. We're trying to educate you for leadership roles in society, and so I dare say many of you will have the experience sometime in your life of moderating a panel. And I want to point out, so I'm going to give you a practical lesson in life. If you tell an economist to take 5 minutes, he will take 10. That's why, and since 10 was what I wanted, I told them 5. Had I told them 10, for sure, they would have taken 20. So it worked out perfectly. The lawyers are more obedient. John, you did it better. You were closer. So just remember that. Now,
It's those salary freezes, Rick, we're worried about.
I think
Reducing the supply of words.
listen, I actually shivered a little bit when I heard about the executive compensation freeze, thinking that we take government money here, But of course, my bonus is 0, so. Anyway, if you think, I think that was a very stimulating set of comments, and in fact, if the stimulus package had had that much stimulus, we wouldn't be having to talk about all this. But I do think that there is a lot of internal consistency in what you heard, and I'll just make one observation about that. I mean, I think or one sort of connective thread. I think that if you begin with John Geanakoplos' view that the fundamental problem that caused this crisis was over-leveraging, and there's ample evidence to support that. Just to give a piece that he didn't give, at the end of 2007, the ratio of public and private debt to GDP stood at 3.5 to 1. It had never been higher than 2.5 to 1 in any previous business cycle peak. So it was way out of line. I mean, out of line for a decade. It was over 2.5 to 1 for almost a decade prior to the peak. So the regulators should have been alert to the fact that there was an awful lot of leverage in the economy. It's the over-leveraging that permitted the housing bubble that Bob Shiller talks about as the proximate cause of the crisis. It was the subprime, and indeed even some of the not subprime mortgages that kept allowing more and more leverage into the housing cycle and spurred housing prices, and they eventually crashed, as John said they would in such cases, and you end up with this vicious circle that leads to the conditions that Bill Nordhaus described, where you start to have enormous losses in asset values and wealth. Lending gets curtailed, spending gets curtailed, and we're in the trouble we are now. So it all coheres, I think, as a picture. The question becomes what to do. I think that there's some consensus there too. At least I hear, implicitly. I think maybe the Yale Economics Department doesn't have enough intellectual diversity, but I think the arguments that the stimulus package itself only does a fraction of what is needed I would agree with that. I would also agree that the recapitalization of the banks is needed and has so far been way less than what is needed. But I think, let's get a little conversation here I'm going to ask John Geanakoplos. You seem to think that fixing the financial system is the main thing to do, but what about macro policy, and what about fiscal stimulus? Is it necessary? Will it all get fixed by fixing the financial system?
Well, once sorry, let me put it this way. The financial system was the cause of our problems. Once the problems start to spread to the real economy, they get worse and worse. And then maybe more things are needed to do than just fix the financial system. But one of the things I always like to point out is that prices collapsed in subprime mortgages 2 years ago. One of the advantages of having a market economy like we do and having all these complicated assets is you can see what, maybe they're not experts because they make mistakes, but the people who have their money at risk are predicting is going to happen in the economy. And in the beginning of 2007, 2 years ago, I have a graph to show it, there was I can show the graph. It's quite startling that, what the hell is this? In 2007, here's the graph. You see how prices have been completely flat if you go to the horizontal line, if you can see that. Can you see that back there? All right. You can't see the graph. All right, well, I'll tell you what's on it. They're totally flat from the left half to the right half. They're at 100. No blip is imaginable. And then halfway through the graph, which is in January of 2007, the prices suddenly collapse. These are of subprime mortgage bonds. They just collapse. Now that means nobody had been thrown out of their houses. Nothing had happened in the economy. You couldn't detect anything wrong with the economy, and the prices completely collapsed. That's because people who looked at the data all the time realized that something was happening, something awful was going to happen. We had 2 years to fix the system. 2 years we did nothing, absolutely nothing. Just from those prices alone, you knew that the market was thinking 50%, 70% of the 5 million subprime homeowners are going to be thrown out onto the streets. They already knew that in 2007. Did we do anything about it? Absolutely nothing. So had we taken the right steps 2 years ago to fix the financial system, we wouldn't gotten to the place we are now. So I think that the financial system is the key, and that's what has to be fixed first, but I agree implicitly with your question that, now that problems have spread so far, we've got to do something else. I like a lot of the things Obama's got in his fiscal plan. We should have been doing them a long time ago, So things that we should do, I'm in favor of doing. Having a bunch of random tax cuts, I'm not so in favor of. But, if we could just move up all those bridges we were going to build 10 years from now and do them all next year, that's the sort of thing I think we should do.
The thing that was missed on the fiscal stimulus, still absent in the package that doesn't make any sense to me, is why we have to think about shovel-ready projects that haven't yet started. They're building a bridge across the Quinnipiac River. It's underway. They're building a bridge, by the way, on Temple Street, okay? Why not double down on the crews, on the work crews, on the projects that are already underway? Why bother to wait for new projects, which will take time?
Part of the stimulus package is a $54 billion 2-year fiscal stabilization policy for the states. Right. So that's $27 billion per year. Right. The state of Connecticut is projecting a deficit of between $6 billion and $8.5 billion. So even if the state of, if we gave it all to the state of Connecticut, it might be all right, but there are 50 states. Right. So this seems like one case where the stimulus bill was inadequate.
Way too small.
Because states are cutting back all kinds of services, they're laying people off, and that would be the place immediately, not to stop the blood.
Bill, you said you would tell us more about your remedies, in which you only alluded to.
Well, I don't have any. I had not thought of immigration as a solution, I have to say, and that's the kind of thinking we need to have today. So I think that I'll just say 3 quick things on remedies. One is, I do think the stimulus plan was probably too small for what we needed. It was probably also stretched out too long. I actually am not of the camp that thinks we ought to have another $1 trillion of public works, because I think it isn't front-loaded enough. I actually do think that something in the order of either temporary or tax cuts, or ones that are, say, time-limited, is a much more effective way of getting the economy going over the time period we're talking about. That's pretty straightforward stuff, and we've actually, that's under the bridge at this point. I can't imagine we'd reopen it until next year. I do think the financial crisis, the banking crisis, and the more general situation is much more challenging, I think, both politically and actually analytically. I think we're going to get, I don't quite know the thinking of the administration, but it seems as if they are trying to go down and figure out, to do the stress test to get people used to the idea that, as I think everybody said, the banks are in trouble. When the stress test comes out and we see the banks that are in trouble, assuming we see that rather than it being confidential information, then I think at that point people are going to be very shocked, and because of the need to find a whole nother set of funds to take care of the banks. Now, one solution that I think was implicit in what John said was that we would basically allow the equity holders of the banks and all the bondholders of the banks to lose all their value. I actually don't know what those numbers are total up to, but they're probably not. I'm pretty sure they're not sufficient. There may be a fraction of the problem. So I do think we're going to end up with needing to take some of the assets off the books of the banks. I think the government's going to have to seize the banks. Seize them is the kind of technical term for take them over. Take the bad assets out, because you can't have a bank with ambiguous valued assets. Recapitalize them if they need it, and sell them off again. I think that the lesson of Japan, which went through this process for almost 20 years, was that in the end you're going to have to do this. The longer you wait to do this, the longer it takes to build public consensus that that's what needs to be done, the more you're just going to have stagnation. So I think this is really going to be an act of real sort of grown-upness among our politicians, whether they can actually face up to the fact that we're going to have to put a lot of money to fix our banking system. I just mentioned one other thing. I've focused on the commercial banks. The commercial banks are about 1/5 of the size of the total U.S. financial system. 80% of the liabilities of the financial system are outside the commercial banks. Pension funds, some of them are pension funds, which are different money market mutual funds, pension funds, insurance, and so on. They're all hedge funds, private equity. I think one of the things that is going to have to happen, and the people in those sectors are not going to like, is we're going to have to spread the net of regulation much broader. And we're going to, if the leverage, and I agree with John that we're going to have to put in binding leverage constraints on a lot of financial institutions, but this is not just banks. This is going to have to be outside the banking system as well. And we're going to hear a lot of cries of anguish from people who were not regulated before and didn't even have to disclose their assets and their balance sheets. We're going to have lots of cries of anguish about how this is unnecessary, unfair, will wreck capitalism, and will tend us down the road to serfdom. But I think that's actually one of the steps we're going to have to take in addition to recapitalization.
John, any lessons from banking regulation? I mean, you know that history. And
So I think that there is a huge lesson from banking regulation. It relates very closely to what Bill was just talking about. So we have, and I think you'll hear this word used a lot in the next few weeks if you haven't heard it already. Our landscape is being taken over by what are known as zombie financial institutions. I don't know if you're familiar with that term, but a zombie financial institution is a financial institution whose liabilities exceed its assets. So it's insolvent in a balance sheet sense, but it has enough cash to kind of keep going for a while. And financial institutions are great at being zombies because to the extent that they can borrow money from the government through the discount window or accept federally insured deposits, they can keep attracting cash for a very long time. So the big lesson in history with respect to dealing with the problem that we're basically confronted with, which is the zombie bank, is what is known in bank regulatory circles as prompt corrective action, prompt intervention. And the reason for that is, imagine that, I own a financial institution that's a zombie, right? So the equity's been wiped out, the liabilities exceed the assets, but I have some cash. So what do? Well, I take the cash and I go to, Mohegan Sun, and I put all the money on odd at the roulette wheel or whatever they have on these roulette wheels, E27. And, if from the standpoint of the owners of this financial institution, if I lose, as I'm likely to do, I'm no worse off than I was. All the risk is being shouldered by the fixed claimants, by the depositors, in our case, the government. Of course, in the off chance that the number that I choose comes up, then, I've made my bonanza, and we've been restored, the assets increase in value, we've been restored to solvency. So this is, classic moral hazard problem, but it's accentuated in the context of regulated financial institutions that have such easy access to debt and government-sponsored credit enhancements on that debt. And the basic lesson of banking regulation, not just in the U.S., but in many other countries that have had financial crises, Japan being one, Sweden, the Czech Republic, Israel went through this, is you have to move very quickly to get the management of these financial institutions into the hands of people whose incentives are aligned with the people who are the real owners, who are the real stakeholders in the bank. And it really bothers me, frankly, and upsets me as a taxpayer that, we've done so little in the financial resolution, in addressing this financial crisis, in getting rid of the incumbent boards of directors and management teams in these financial institutions. Not because they make so much money, it's rather because of this moral hazard that I just described, and so I think that we need to move quickly to clear those decks.
Bob, yeah, sure.
The really important point was just made, which is banks that are, these zombie banks, or the banks that are close to the line, are dangerous. They're very dangerous because you're in the situation where they can take risks, and if they win, they're alive, and if they lose,
Other people die.
The taxpayer has to take them over. All right, so they're actually, it's one of the lessons is when good banks go bad, they become dangerous. And I think that was a very important point that I think has actually not been made in the public discourse on this.
But technically, the Japanese banks were zombie banks for a long time. Yep. And they didn't really go crazy taking risks the way you're suggesting.
No, because they were so bad they had no chance of getting good.
One more question, then we'll open it up. Bob, I want to come back to the housing market. I know you have a lot of prescriptions, but among most of your prescriptions are looking to the long term how to prevent another asset bubble of the type that occurred. How about in terms of getting us out of trouble? I mean, would you agree with John that we ought to be writing down the value of outstanding housing debt?
Oh, yeah, I agree with John wholeheartedly.
Right.
I had in my book Subprime Solution, I had a less well-formulated version of it. I said we should restart the Homeowners Loan Corporation, which was created in 1933 and which bailed out about 20% of U.S. mortgages. And so that's what you want to do, something like that. And apparently what we'll hear tomorrow from the president, based on news speculation, is that he will be subsidizing a lower mortgage rate. And that doesn't solve the problem. So we'll see. I think this is a big issue, that we're foreclosing people and throwing them out of their houses. And I think this generates bad feeling. And this is part of the sense of confidence that we have in our economy, that we feel fairly treated. These people are not being fairly treated. Now, some people would say we ought to teach them a lesson that they have to pay their debts. But I think that people will learn the wrong lesson if they are foreclosed and thrown out of their house.
But don't you think, I mean, there is, as John was saying, there is a difference between lowering the interest rate. I mean, technically, both lowering the interest rate and writing down the mortgage lower the present value of payments that people have to make, but over the life of the asset. But of their obligation. But writing down the value of the mortgage actually leaves people with positive equity, which has some different behavioral implications, right? Wouldn't you
Right.
want to do that preferably to?
Yeah, and so what I think is that we should be systematic about doing that. Incidentally, we shouldn't be just doing it as an emergency. This reminds me of the Homeowners Loan Corporation again. At the same time that they created the HOLC, they also generated new and better mortgage institutions. So this shouldn't be a one-time only thing. We should be thinking about making this systematic.
Very good. You want to answer?
Could I just
Yeah.
point to that? So I don't know whether John was being a little tongue-in-cheek about, filling up all these foreclosed houses with immigrants, but, I think that we have to, the people who are in the houses should stay in the houses. We shouldn't just throw them all out and put immigrants in their houses. And so,
Probably not, yeah.
so
Thank you for that correction, John.
So the reason they're being thrown out is because it's a collective action problem. The servicers who are in charge of rewriting the mortgages just can't do it. And so it helps nobody to throw these people out of their houses. What the public doesn't realize is the market, in those pictures I showed you, forecasts that the typical subprime person, when he's thrown out of his house, you'll get 25 cents on the dollar back by reselling the house. It's incredibly expensive to throw someone out of their house. It takes a year and a half. They trash the house. They don't pay for a year and a half. They don't pay taxes for a year and a half. You have to hire a real estate agent to resell it. Incredible number of expenses. 25 cents on the dollar is what's expected. Throwing people out of their houses helps not the people, and it doesn't help the bondholders either. So the mortgages have to be reworked. The only way, I believe, and that's what Bob's saying too, to get the people to pay is to make it so that the house, which may be worth 50 or 60 now, is more than the loan. If the house is worth 60 and the loan's down to 50, these people have something to fight for. They know if they can make their payments and scrape by for a few years, they can sell the house and get more money, make a profit. You see, if you lower the interest, the guy knows it's not his house. No matter when he sells it, the loan's going to be more than the value of the house. You lower the interest rate by 2% when the loan is 100 and the house is worth 50. That means it's not your house, and they'll treat it like it's not their house. The only way to make it their house again is to lower the loan below the principal. And you can say, just as Bob said, oh, that's so terrible, those people, they've cheated the system, they're scoundrels, let's screw them, okay? But we're screwing ourselves by trying to screw them. It's not to help them so much, although that's important, it's to help everybody that we don't throw them out of their houses.
Maybe we'll open up for some questions from the floor. There are microphones at the front of each aisle. And you can direct them at one particular panelist, if you would.
My question is for Professor Macey. Following up on that discussion on the servicers we need to get these servicers to lower the principal. We need to change the value of these mortgages. That's the only solution. We've all seemed, on the panel, everybody seems to agree with that. So my question for you, Professor Macey, and we came from an earlier talk today that you and I both attended, how do you make that happen? Legally, how do we make that happen? These asset holders, the people that hold these securities, can they litigate to prevent that? Can they litigate to prevent the servicers from changing the principal?
Right. Okay, so that's a great question. The critical term that I think John used a moment ago was a collective action problem. And if I could, here, basically the problem is this. It's fascinating, really, if you think about it. Imagine someone's in a house, and their mortgage payment is $1,500 a month. And the person cannot afford to pay that anymore. Imagine that if there's foreclosure, et cetera, the person who holds that mortgage will receive $200 a month in the future. Both parties would be better off by reaching some kind of accommodation where some amount greater than 200 and less than 1,400, say 800, would be paid and allow the person to stay in their house. And one of the most staggering things from a legal perspective, and kind of from a law and economics perspective about the current crisis, is that most economists, and I think you're absolutely correct, look around the economy and they see millions and millions of these potentially jointly wealth maximizing deals, contracts that could be made between people in houses and and the owners of the ultimate payment stream, the owners of the mortgages, to work out a deal, a contract abridgment that would make both parties better off. And it's stunning that there appear to be kind of legal obstacles to making this work. I think that the solution is pretty simple, which is there's sort of technical rules in the bankruptcy code which make it very difficult for bankruptcy judges to reach this middle ground and to change the amount of money that people in houses get to pay. Also, it's much easier for just odd historical reasons to rewrite non-mortgage contracts. So my legal solution would be, and there probably are others that would work as well or maybe better, but is to change the bankruptcy code to allow the changes in these mortgage contracts such that you could do exactly what John was and Bob were suggesting. I think that of lowering the amount of money that people pay, and this would make the creditors better off as well as the debtors.
Since everyone seems to agree with this idea, I would like to say that I'm skeptical, as John knows. I think the housing mortgage problem is one that needs a wholesale solution, and I think this is retail. I'll just give one example why. I think it's much too complex. There are too many mortgages, and John will have to talk for the length of the Great Depression before he actually persuades enough people that this is going to be written into law, gets written into law, and actually gets undertaken. The federal government did something which was a similar thing, passed a law last fall. They did at the 90-day review, they reviewed how many mortgages had been rewritten under the federal law, and as of that time, there were 13 contracts had been entered into, and 0 had actually been rewritten. And I think the problem with trying to reform the servicers and all these tens of millions of badly out of whack coordination problems is it simply won't get done unless this is a decade-long problem. It won't get done on the timescale that we need it to get done. And meanwhile, housing prices are falling 2% per month. If they keep going at 2% per month, according to the Case-Shiller index, if they keep falling at that, then by the time we've had 2 years, according to John already, people still haven't figured it out. Another 2 years, housing prices will be down another 25%, and presumably at that point, we'll have solved the problem, not through fixing the servicer problem, but basically because the housing bubble will come to an end and housing prices will stop falling. I think there may be some more wholesale ways of doing it, and I actually think a combination of interest rate relief and even radical ideas like tax credits for mortgage payments are much likely to get to more people than trying to refine the bankruptcy code.
There's an obvious macro solution, though, which is use the Case-Shiller index and just write down all the mortgages by the decline in housing values. I mean, there's a simple, kind of Occam's razor macro solution if you want to use it.
Could I make a comment? So, I have enormous respect for my colleague Bill and for his judgment about what's political and what's not political, but I think he raises an interesting point here. Why is it that for 2 years nobody did anything about this problem? Now, it's clear that the private sector wasn't going to solve the problem because the servicers had a conflict of interest. Their interest, the servicers are the people who are delegated the authority to handle the loans by the bondholders who own them. The servicers don't generally own any of the cash flows. So they're not getting the money by doing something better and improving the loan and getting more money. They're not getting any of it. So they have no incentive to go to a huge amount of trouble to change everything around when they don't see any of the money. It's incredibly expensive. They don't get anything for it. And on top of that, they run the risk of getting sued. So it's obvious why for 2 years they didn't solve the problem. The question is, why didn't Bill Nordhaus and other great economists, why didn't they help solve the problem? Why didn't George Bush and his administration start to solve the problem? I think Bill's put his finger on part of it, that it requires a radical solution, and people, are hesitant to do radical things. But what I'm proposing, okay, so I proposed that the government go out and hire a bunch of bankers, community bankers, to rework all these loans. They might have to hire several thousand of them, maybe 10,000 of them, okay? But they're bankers all over the country, either unemployed or working at banks, and would gladly take these jobs. It's not a problem to find the manpower. Okay, and the thing is, this could have been started 2 years ago, or could have been started 4 months ago. You can't reduce the principal of every house in the country. There are too many houses, that's too big a loss. Then you really kill the bondholders. We're talking about the subprime. Many people in the, let's say the typical middle-class family from Peoria, they're going to pay their mortgage. They'll fight to the end to pay their mortgage. It's their whole dignity, their family moving, their schools being given up. They're going to pay their mortgage. But the subprime borrower, people like that who are all living on the edge already, they're the ones who make the calculation it's not worth it to pay. They're the ones who need the loan written down and to keep them in the house and to keep them going. I don't think this is any harder to do than to reduce the interest rate by a couple percent. It might take a few more months, but I think writing down the interest rate a couple percent is not going to do anything. Bush has had 25 different policies, if you've been watching over the last year, where the FHA does this and someone else does that, and a few loans change here and there, and nothing gets solved. It requires a wholesale, that was Bill's word, a wholesale solution to the problem. We have to get on it and do something. And yes, there's resistance. Whenever I say this idea, the government has to hire all these guys to look at the loans and write them down, to the right level, write it down so you can actually expect the guy to pay. There's no point in writing the loan from 100 to 50 if you know the guy's not even going to pay 50. So you have to look at the people and look at what they have. So it's a little bit different than just using the Case-Shiller index. You have to look at the homeowner, see what the housing values are, then write it down. So it takes a little bit of trouble, few people you have to hire. But we've got to do this on a grand scale. If this is the Great Depression, we're between one epoch and another, as Bob was saying, it's going to require a little bit of effort on the government's part.
Could I add that in 1933, I mentioned the Homeowners Loan Corporation, and doing that involved, they got 20% of all mortgages refinanced, and they looked at them individually. They hired people, they set up offices in every major city, and people would go to the office and they would apply and they would be evaluated and their mortgage would be adjusted. It happened.
Bankers rented out for less in those days. Okay, another question.
Hi, I have a question about the zombie institutions. So I am wondering what you guys think of the proposal of just letting them fall apart, as opposed to doing Lehman Brothers again, as opposed to taking over them a la, the Swiss, and not going the Japan way, taking them over, recapitalizing, infusing them, and trying to make them really good banks all over again. Why not just alternatively let them fall apart like Lehman? I understand, now that certain parts of Lehman are actually quite valuable, like their prime brokerage, and so if you let these really big institutions fall apart but then get bought out, or their profitable parts of them get bought out, why wouldn't that be a less costly solution? I mean, is that just going to wreak havoc all over the place, or might that be a way to go?
Bill.
Can I just say, I think the worst single decision that was made outside of the war in Iraq over the last 8 years was the decision to let Lehman go bankrupt. And the reason, and it's not that you couldn't wind them up, but the fact that you basically broke all the links. Somebody told me that Lehman had 100,000 contracts, and who knows what happened to all those contracts. So what you need to do is the first thing you said. You need to basically take them over in an orderly way. You need to get a structured procedure, and we actually have a structured procedure. We do this with banks all the time, to take them over and to take them apart, to put them back together. But the idea of just letting them go, in the sense of the way Lehman did, is not going to work. What you had is, if Lehman went at 12 o'clock, at 12:01, you had thousands of people seizing collateral, calling people up, calling the lawyers, trying to figure out what to do, and you had a freezing up. And if you actually look, I'm sorry we don't have a little graph here of what happened to all the risk spreads. You can follow the risk spreads, and what happened is the system went haywire when that was allowed to happen. And you can imagine if that was allowed to happen for bank after bank after financial institution after financial institution. So I think we have to go in and we have to clean them up, but that is, I think that's a very dangerous precedent to follow.
They're basically, you can divide all the experts on the financial crisis into two groups. One group are the people who say that the biggest mistake we've ever made was allowing Lehman Brothers to fail. And the other group is saying just about the only thing we've done right in this crisis is to let Lehman fail. I think Professor Nordhaus, though, touched on something very important, which is neither one of those answers, in my view, and I think this is consistent with his answer, although I may be wrong, is right. And the way to think about it is, if you think about it, and again, this gets back to the point I was making earlier about this very different regulatory structure we have for banks versus non-banking firms. In the U.S., if you're a non-banking firm and you're insolvent, like Lehman Brothers was an investment bank, not a bank, they become bankrupt. And they file in bankruptcy court for protection under Chapter 11 usually, which is what Lehman Brothers did of the bankruptcy code. If you're a commercial bank, you're prohibited by statute for filing for bankruptcy protection. And exactly as Professor Nordhaus said, the government regulators are required to come in and, quote, resolve, unquote, the financial institution. Oddly and unfortunately, one of the things that, to my way of thinking, we've learned from this financial crisis is that the alternative structure that we have in place for banks, for resolving failed banking institutions, is much, much more efficient than the bankruptcy process that Lehman Brothers is subjected to. So my view is, yes, I kind of think, I disagree with Professor Nordhaus. I think we should have let Lehman Brothers fail, but I don't think we should have let it fail the way that it failed. I think that we should have allowed it to fail the way we allowed Bear Stearns to fail, or to resolve it in the context of a managed process that's overseen by regulators. Now, if we listen to what's gone on in Washington the past couple of days, and we hear this famous word someone mentioned before, this idea of we're going to go into banks and stress test banks, that's what they're saying. They're saying, look, other institutions are going to fail because you give people stress tests. It's not like Yale Law School. Some people actually fail. So and the ones that failed are going to be resolved some way. Hopefully not the way that Lehman Brothers was resolved, right? But hopefully in a more organized way.
So the next question.
There's been a lot of talk recently about prioritizing different parts of both the bailout of the financial institutions as well as the stimulus. So I wanted to ask for anyone on the panel who wanted to talk about it, if you were given $787 billion to do whatever in whatever order you thought was necessary, and one or two regulations or policies that you could undo or create, what would they be, and in what order you'd go through that process?
Who wants to try that one?
That's the stimulus, not the TARP.
No, he's saying if you had 787, period, right? Stimulus and TARP. It could be, anything. Set the priorities.
I'll just say one priority, because if we each give our own list, the whole list, it'll take too long. So I would re-leverage the system. So how does, I think Geithner's going to announce something like this, and I think he's going to probably announce, I hope he does the right thing, I'll put it that way. So as I said, the problem was that people used to be able to borrow 98 cents, on a AAA security, used to be able to borrow 98% of the value, 98.4% of the value for AAA security. You only had to put 1.6% down in cash to buy it. So that's what kept the price so high. Now you can borrow almost nothing, even on AAA securities. There basically aren't any AAA securities left in the mortgage world, practically. So you can't borrow on them, or you can borrow just a little bit. So what the Fed, Geithner's talking about partnering with the private sector. What does he mean by that? The government can't go off and buy securities. It doesn't know how much to pay for them. It doesn't understand them. It would have to hire an entire research department, and even the research guys sometimes don't know. You need to hire experienced traders and researchers. It's just a very complicated thing. They're definitely going to get outsmarted by the people trying to sell the stuff. So I think they're hopefully recognizing that. So what I would do is I would go directly to the buyers, whether they're hedge funds or banks or whoever wants to buy these securities. These are the toxic things the banks have on their balance sheets that have such a low value because no one can buy them anymore because they can't borrow to get them. I'd say if you want to buy those securities, we'll lend you 50% or 60% of the value of the security. Now, the private sector won't lend 50 or 60 or 70% of the value of the security because they're too scared they might lose money. So the private sector is not crazy. There must be a risk that they will lose money. So the Fed, the government, is going to be running a risk doing that. And so you have to so part of the money I would set aside in case they lose a little money on that. But if you lend 60% against a $100 security, the security goes down 40% in value, you lose nothing as the federal government. Though the private sector who bought it loses that 40%. If the government buys directly and it goes down 40%, the taxpayer loses 40%. So you have this huge 40% cushion. And so I would partner with the private industry by getting the private sector to buy, but help fuel that buying by making government loans at more generous collateral terms than the private sector is willing to do, which of course means running a risk, and you'd have to set aside money to cover that risk. I believe that once they get that going, they'll have to pump in a lot of money, hundreds of billions, maybe $1 trillion of loans, something like that. They'll start to raise a lot of these security prices, and some of the banks' balance sheets won't look as bad, and it won't be so easy to invest in old securities. People do new things. So that was the one thing.
Right. John's illustrating a point that's worth keeping in mind that you just don't, if you read the press, you would never understand. And that is that the money that's been used for the financial system is actually of different, it's not commensurate with the stimulus money. The stimulus money is direct spending that is going to add to the national deficit. So far, something like buying preferred shares in banks or taking partnerships in supporting loan and giving loans to the private sector to buy assets, these are investments the government's making. They're not actually, they're not going to necessarily, they might be bad investments. Bill thinks they're bad investments, but the point is they're different. They have the prospect of earning a return. I mean, if in fact we recapitalize the banks, leaving aside John's scheme, going to something more like what we did with TARP 1, and take preferred shares and by recapitalizing the banks that pay 6%. I mean, if we're right, we get a 6% return on the public money, and the banks are recapitalized. So you can't really add them up. The money's it's a different type of government transaction.
I want to answer the question directly. I think that the central issue we face is that we have to get the economy back toward full employment. Until we do that, all these problems are going to be with us. They may not be with us the same way, but if you have a highly depressed economy with corporations basically living on the edge of bankruptcy, the car companies can't sell enough cars and so on and so forth, you're going to have profits down, you're going to have highly leveraged institutions in trouble. That's not just the banking system, but the other highly leveraged institutions. Profits go way down in deep recessions, and when profits go down, securities markets are in trouble. So I think the key thing, I think we have two hands so we can do two things at once, but if you only had one hand, I think what I'd do with the one hand is focus primarily on trying to get the economy back to full employment. But I think we can do both. But I think that's, unless you do that, you're going to have trouble all across the financial
That means
system.
a stimulus package? It would be all stimulus?
No, whether it's stimulus or whatever, there are lots of ways to do it. And fixing the financial system helps do that. But I don't think if you fix the financial system in the middle of a depression, it's not going to bring you back to, it's not going to stimulate the economy.
By the way, you gave us a problem of using only $787 billion. It reminds me that this is a world problem, and it's just too small a number to work with. The world economy is something like closer to 100 trillion. So
It's nowhere near enough, actually. But you're right. But it's good to focus the priority. Yeah.
I would just like to follow up a little bit more on the problem of the illiquid mortgage-backed securities that a lot of financial institutions are holding, just in respect to the fact that they're holding these securities, and that a lot of the problem seems to be that no one knows the value of those securities, and that my understanding is that a lot of these institutions are refusing to sell them because of the losses they'll be forced to take, and how we can re-leverage the system when we don't know the value of the assets the banks are holding, and if they're forced to sell them, that might force them to more insolvency. And I know part of that has to do with a lot of people asking for an end to mark-to-market regulations, but I don't know if that would be good or not. So, for Professor Geanakoplos, probably, since...
Okay. Well, your question really combines two problems. One is the problem of the banks and whether they're really underwater or not. And if they actually sell things, they'll have to admit what the price is they sold it for when they've got them marked on their books at a higher price. So that gets to the question of how we're going to rescue these banks. And I think we have to recognize that the banks are more underwater than we've been told. And, you know, it's just, I don't know that for a fact, it just seems obvious. I mean, every week, you know, there's more bad news and they're worse than they were the week before. So, I mean, it can't be that all of a sudden we're going to be getting good news instead of bad news. So it's going to get worse and worse, and they're going to be hundreds of billions underwater. So if they're that far underwater, we have to start to come to grips with that and figure out what we're going to do about them. And, you know, just hiding the problem by letting them mark their things wherever they want to mark them is not solving any problems. So if we can actually get the prices up and get them to sell them and clear their balance sheets off, even if it reveals that they're way underwater, that's got to be better. And we can figure out how to reorganize them afterwards, you know, spin off part of the bank and let the rest collapse or something. So the second thing is, you know, they are hard to value. That's why the government can't possibly figure out what to pay for them. But, you know, there are people who make their living trying to value these things, and there's a huge financial system. You know, there are thousands of players. Let them try to value them and let them try to buy them. That's what they're supposed to do. And if they have access to borrowing something, they'll buy more stuff, and then we'll find out what the values are. They'll be higher than they are now.
You know, but obviously the values depend on what the macroeconomic solution is, right? The default rate figures heavily into determining the value. The default rate's going to depend on whether we take any of these approaches in the home mortgage market that you and Bob have been advocating. So it's a very tough problem. Even the experts are going to be guessing.
It's called the macroeconomics of self-fulfilling prophecies.
Right, exactly. I think it's been 90 minutes. That was what we sort of promised the panelists. It's been really stimulating conversation. I agree. I'm sorry that we can't take all the questions that have been lined up, but thanks for coming along. And we'll, you know, there'll be stimulus 2 sometime this summer, is my prediction, and we can be back in September with another round. Thank you.